Hey, everyone here at the Investing Stuff You Should Know podcast. This is where we bring you live insights and active insights from the world of investing. We have a great guest with us today, Sarah Sullivan. She has a fantastic capital group. She's the founder, CEO, president. I think she's all those things. Sarah, thank you for being with us today and for participating in, at least in my Investing Stuff You Should Know, first live podcast slash webinar slash guest invite. This is exciting.
Hello, everyone in live land. Thanks for having me here, Johnny. It's really special. Things you should know in investing, like near and dear to my heart. I love educating investors with everything I've learned over the last 10 years so that they can take the shortcut and not make the mistakes or go through the long path that I had to take. So happy to be here and add value. And hello to all the listeners.
Wonderful, Sarah. So, well, let's just hit right into the questions here. So, a lot of my audience are professionals. I was a mechanical engineer myself. Spent about 10 years in that space. I had another career before that basically as a builder. But so I know a lot of folks in that space, and they are interested in knowing about how can they get into real estate investing. Yes, they probably have heard about, you could just sell your home, or maybe you could do a flip. But also there's this other piece that's a little more rarefied, and that's in the kind of the commercial space here. So we'll talk about all the different things you've seen. I know you've seen a lot in more the residential and the larger side. But we'll just hit off with the first question here. So give us your own journey into the world of real estate investing, if you could.
Yeah, definitely. So I started working after college. I did economics, and I thought, oh, I've got this great degree from a great college, a UC, great job. Life's going to be really great, but it was really tight financially. So I said, oh, what's the best way to make more money? Okay, I'm going to go back. I'm going to get an MBA in finance and marketing, and then I'm going to, make the big bucks. I went back to work and worked in corporate, kind of going up from manager, senior manager, director in tech companies. And I still found that money was tight. I was not, I needed to figure out, once the money comes in, how do I keep more of it and how do I grow more of it? And I think that's really true for so many successful people in the world who are really smart and focus on education, is that then they focus on their career, their job, how to bring money in the door, but they don't focus enough on how to keep more of it, like tax strategy, and how to grow more of it, investing. And so it was right about when I had my first baby 10 years ago that I was like, I gotta shift in order to be in this long-term planning mindset. And so I started looking at people around me who were home during the day and were living, going on more vacations than me. I'm like, I want to do what they're doing.
Yes.
And living in Silicon Valley, a lot of people had made their money in tech and then invested in real estate with that money. And they were living off of the passive income from real estate. So I started asking, because it's like, where is your real estate? Oh, it's in Texas. Oh, it's in Florida. Oh, we don't manage anything. I'm like, how do you do that? And they said, oh, this thing called syndications. And they explained it to me. And then I was like, that's fascinating. It truly is hands off. And you get to participate at a really big lower risk level. So I started investing in it. Then I started telling my friends and family about it. And then I started telling more people and more people. And then I was like, wow, I can build a company around this. And I built Sugo Capital, and it's all around educating investors on different types of investing to see what's right for you. And then if our types of investments are right for your investment goals, then we connect people. But I love what you said about, most people probably know about 2 or 3 different types of real estate investing. And if it's fine, if you guys go to sugocapital.com, somewhere one of the tabs is to a 3-day challenge. And the very first day, in the first 5 minutes, I have a slide, and it's 15 ways to make money in real estate. And it goes through okay, you probably know about fix and flip and Airbnb and, buy and hold a single family real estate that are very scalable. It's not exactly scalable to have your job, your career that you're really passionate about and really good at, and also have 10 Airbnbs. So how do you invest in real estate in a scalable way? So this chart is really cool because it's like everything I learned over the last 10 years, Johnny, and about different types of investments. What are their ROI? What is their cash flow? What is their annualized return? What is the hold period? What is their liquidity? Because these are all things you want to be able to see how it fits into your investment plan as a busy working professional.
And all the questions, of course, Sarah, that the professional want to know up front. Maybe a lot of people have a 401k, maybe a Roth IRA, and there's these other investments. So they're savvy with their money, but maybe they haven't heard about it, or and also like, well, this makes sense. My friends and family or people that are seem to be doing well are doing this. So you want to kind of like walk through like, so what are the basics? And that, like you said, that tool, that template you have is an awesome tool for just to give people just a little bit of confidence. Just, we're not getting all hyped up, we're not like running around saying a bunch of promising incredible things. Just like, hey, these are the basics. You just walk through slowly and carefully, and just give you a sense of where this could go and if it's right for you and your family.
Hmm. Yeah, exactly. And especially, working professionals who want to be hands off, it's not always feasible in the place you live in. So I always like to say, like, buy real estate where you want to live. That's not always the best place to buy real estate to make income off of, or as an investment property. It might be in another state, right? Certainly in San Francisco, you don't want to own investment property. Certainly in Texas, it's a great place. But as a working professional, how are you going to manage property in Texas? Well, there's something called syndications, private placements, and it's where other people like me and my partners manage your investments, and you just put your money in and watch it build. And all these kinds of private investments, you can choose them based on time you want your money to be held. You can, do you prefer income like monthly checks or quarterly checks, or you're like, hey, this is in my IRA or this is in my 401k and it's for later. Appreciation is most important to me. Wealth preservation, wealth building is most important to me. For those kind of folks with those goals, then we have these offerings that have really strong annualized returns at the exit, and especially if you're holding them in a tax advantaged account like qualified funds, then that's very beneficial for wealth growth.
For sure. Have you offered over time, Sarah, and this kind of speaking more to the syndication community, have you offered various like higher cash flow properties or higher equity build properties? Have you been able to offer that over time? And that way, I think what I'm getting after there is like, you can, at times people can tailor it. So like, oh, this is not right for me because I need cash flow now, or I want to see equity build. Like, hang on. Like, oftentimes sponsors like yourself are able to offer or will be offering it's kind of like, these offerings will come up and you just keep your eye open. Is that true? Have you been able to offer that?
Yes, 100%. So we've acquired 24 apartment complexes. And so each one of those has a different structure. Some of them are within a fund, some of them are individual. And I'll give an example. So we buy a property in a location and it's 400 units, 400 doors within one complex. And it's already in great shape. It's got great tenants in there. It's cash flowing. So we say to investors, hey, there's not a huge value add here. It's already doing great. Cash flow is going to be 8-9%. And then we exit, you'll get some capital gains, but it might be like 5% per year. So that could be an offering. Another offering might be, hey, we're building a new 300 unit apartment complex. It's not going to cash flow for 3 years because it's dirt right now and bulldozers. But when we lease it up and we get it, primo tenants in there, primo net operating income, and we sell it in 5 years, you'll get a lump sum check that's equal to 125% of your initial investment. So it's a really big chunk on the back end and not any cash flow in between. So they're still both apartment complexes. They're still both passive income or passive investments for investors who want to be in real estate and be hands off, but totally different financial structure as far as when you receive the money as an investor. So thanks for bringing that up, because we do have those examples I gave are real offerings we had.
Yeah. I like to pivot backwards, and this is a little bit about a sequence, I think, from the kind of direction we've been going, but just it just stuck in my mind. It's so interesting to me that uh, successful folks, very entrepreneurial, smart people, like you said, in Silicon Valley, in the San Francisco area, make their money in, apps and software and, societal changing things, but then they still go back to real estate. I think you kind of addressed that, but I just like the point is so important because it's like even the smartest people doing the most cutting edge things, they still are compelled to put their money into some type of real estate, some type of tangible asset. So or Sarah, could you talk to us a little bit about that? Why that it almost seems like as a discordant thought. They're like, well, shouldn't you want to put that into some other the next startup or the next, cutting edge thing, AI or something? Why do they go back to something as basic, as fundamental as a house or a residence for a human being?
For wealth preservation, and for more secure growth. So if you look at the number of apartment buildings that have been offered out to investors and have been successful and where investors have made money, the percent is much higher than people who've invested in tech companies and who have made money in tech companies. So it is around wealth preservation and legacy. However, a lot of people do, there's a stack, there's a formula that family offices follow for, the uber wealthy, and it's a little different for each one. But what I've looked to mirror and what I kind of share with people to mirror is about 60% of your portfolio in something that is a wealth preservation investment. So for me, that's apartment complexes. It's very recession resistant, resilient when it comes to inflation, all these other things. People always need homes, it's tax advantage. So that's my 60%. And so a lot of people, when they make their money in tech, they do the same. They put a chunk in a wealth preservation asset, a hard asset that's not going to disappear overnight. It's not likely to go to zero, right?
Yeah.
There's
Yeah.
still risks in all investments. But then what's the other 40%? So then maybe some cash flowing investments that don't appreciate, some VC type investments. So they still do bring their money back, but it's not 100%. It's not like, oh, I made 7 million in this exit, I'm going to put 7 million back in some tech. No, they might be like, okay, I'm going to put 5 million in real estate, save $1 million to disperse among some startups and do some angel investing with 10 different angel startups. So it is a both. It's just a percentage stack, and people want to have that safety and security that real estate brings. And then also when you're at that volume, you can easily become a full-time real estate operator if you're not careful. If, if you're doing the single family homes and the Airbnbs, like, yeah, I mean, you have a couple million, you can buy a lot of properties, but then that's going to take a lot of your time. So you do have to pay attention to what do you want. Some people want to do that. Some
Yes.
people don't. So
Yeah.
know
It'll
that.
subsume your life. It'll like absorb it, So like
Yeah.
to your point, it's so important because I have some coaching clients and like, well, what do you want to do? And it's like, so do you want to like buy a duplex or whatever? And like, how important is your time to you? And let's map out where you want to go. What's the vision for you and your family? And know that you're basically trading this for time. And that's the thing you kind of mentioned at the beginning of our conversation was like, oh, like I don't have to manage it and these other things where you can stay not so much in your lane, but stay maybe what you're passionate about or what you're good at right now, and then kind of build up this investing side of your family arsenal and have that
Mhm.
growing and coming in as well.
Mm-hmm. Yep, exactly. So I did start out in the single family homes and Airbnbs, and then I switched over to the syndications, and then I switched over even more. I quit my job, and now I have a syndication company. So now it is active again, but it's super fun.
It
That's not
is.
always the path for everyone, but it's a fun path.
For sure. Talk to us, and I'm circling back a little bit too, but also it's kind of just on our order of questions here, Sarah, and that is the why wouldn't you invest in California? And you and I that are like maybe live in the space or in the space all the time, like, well, of course, why would you invest in California? And you want to, invest in a emerging or secondary, the secondary markets here. What are some things just as a as an expert operator that you would share with perhaps new investors, like why don't you invest in California and you like to invest in, maybe Texas or Florida or the Carolinas or a different place where you have your own investments?
Yeah, basically for the numbers, for the economics, we invest to make money, right? And so I'll give an example. Our single family home, we during COVID we moved to France and we rented out our home. We rented out our home for about 60% of the mortgage. So 40% was coming out of pocket while we were renting our home at maximum rent for our market. Now you might think, well, that doesn't make sense. Correct. It doesn't make sense. Um, and yet people are buying homes and renting them for less than the mortgage.
Yeah.
And they say to me, it's not that bad. I'm only paying 2,000 a month out of pocket in hopes for appreciation. And I'm like, or you could make 8% per year and bank on appreciation if you're in a different market. So it's just the numbers is one thing. Like the numbers don't work as far as single family homes. I'll give another example. My friend, he was like, "Oh, I see what you're doing, and I'm going to do it too." And I was like, "There's a lot to learn. Don't just go out and do it." He's like, "No, no, I'm really smart. I'm an engineer. I got this. I got a buddy. We're going to go." They bought a 10-unit apartment complex in Sacramento. And he was like, it's pretty good. Between the two of us, we're only down $5,000 a month. And I was like,
Amo-
I don't understand, but people say these things. So is the economics in California are that the rental prices are lower than the mortgage. Now, if you go to a place like Indianapolis, where the rental prices are higher than the mortgage, that's where you want to be a landlord. Can I rent it for $3,000 a month, but my mortgage is $1,200 a month? That makes sense. You get to keep the extra. So it's really purely economics is the biggest factor for me. The second is to take a look at the political climate and the landlord friendliness of a state, even down to the city and the county. So particularly in California, I'll give an example. This is also while we were in the middle of a lease on a property,
yeah.
the county rules changed around, and it didn't matter if you already had a certain type of lease in place, the rules changed. It negated parts of that lease. And so when it came time end of lease, we couldn't get the tenant out for about 6 months. We got an attorney. They said, yeah, nothing you can do. Now, collectively, this couple made $1 million a year. So, and we verified with their employers that they were not in any sort of hardship. They were getting their paychecks every month, but they were not paying us rent. But we couldn't get them out of the rental property. And the attorney said, why don't you try paying them $40,000 to move out? Who wants a rental property here? No. So Texas is very landlord friendly. We work with our tenants. If they don't pay their rent, we ask why. Do you need an installment plan? Do you need some more time? Can you pay half now, half on the 15th? But if they're really unable to pay, we are able to say, okay, it's time for you to move out. And we're able to get a paying tenant in and move on, because our first responsibility is to our investors, right? So you got to look for places that are landlord friendly, the rules. That's the second thing.
Absolutely.
Yeah.
So that's really good. So let's look at moving on here. Let's see here. Oh, I see. Here's a good question for us. What are some common misconceptions or mistakes you've observed among those starting out in real estate investing? Um, Again, our audience is successful professionals that want to step into this here. So I know you've seen many of those kinds of folks come into your world, people that you know, friends, family, colleagues, and whatnot. And you've seen a lot of things. So give us, maybe they thought one thing and it was
Yeah.
something else. Give us some insight in there.
Yeah, perfect. So the number one thing I see, and the context is I had 750 investor strategy calls last year. 750.
Wow.
I'd say about 60% of those were people who were successful W-2, folks. So intelligent, smart, and they had 1 to 3 single family home rentals. And they had thought that the easiest way to get into real estate was to buy some single family home rentals. They had thought that the best way for cash flow was to buy, 1, 2, or 3, like, oh, we can just stack single family home rentals. And they were like, we're exhausted. This is totally not what we thought it would be. So the thought that, oh, I'm just going to get started. So probably the best place to start is the smallest, most accessible thing. And so that's the most common mistake I see. Instead of, I'm about to I want to get started in this. There's probably someone who's very experienced and professional that I can just give my money to. And it doesn't mean give your money to me. It means find an operator who you really resonate with, who does what you want to invest in, and let them be the professionals. You don't try to do your own taxes probably, because there's someone who lives and breathes that all day long, right? And they're the expert, and it's the headache you don't want to deal with.
Yeah.
I think that's the number one I see.
Yeah, and then the potential loss that you might encounter by doing it yourself is really not. I mean, there's a great deal of uncertainty, fear, and then also just like with anything of a high reward in life, there's a reason why professionals exist in the space, because they're quite good at it. So don't be afraid to have those training wheels, pair along with professional, and then maybe it's your thing, and you can also just see if it's like if you resonate with that activity. Maybe you do, maybe you love it and you go all the way and start becoming a real estate professional yourself, or maybe you don't, and let people like yourself just keep handling that part of your life and just developing a better and better relationship.
I'd like to add that the number two mistake I see is that people think that they can use the depreciation and loss from real estate to offset their W-2 income. If without them being a real estate professional or their spouse being a real estate professional. And that breaks my heart because sometimes they don't realize it until tax time and they're like, wait, I thought I was going to get this huge write-off on my W-2 income. It's like, no, it's separate, passive income and active income. And they don't blend unless you're a real estate professional or your spouse is. So not fully understanding the tax benefits, because there is a way that it can benefit you. And so I guess that's the number two mistake, is not fully understanding how the tax works around this in order to maximize the benefit.
And then we know we've both seen it, I'm sure, out there on social media and maybe just even in events. We hear about tax benefits and we hear about real estate investing and successful, professionals. And then somehow we mingle that together and to exactly to that point. And it's like, oh, I thought we are going to get this. And it's actually, no, it's like you do get it and you can get it. And there's ways of getting it, but it's very specific and you got to follow the rules and the laws. And you just want to make sure you're comprehending and understanding what that actually means
Mm-hmm.
for your situation.
Yeah, and I'll give some more examples in case people are not familiar with it. So, investing in an apartment complex, we do a certain study and analysis and a tax strategy that allows investors to get maybe 60, 70% tax write-off in the first year. So like if you invest $100,000, you could get a loss of $60,000 or $70,000. Now, a lot of people think, oh, I can take that against my W-2 income. No, you can't. However, I know we're talking about real estate here, but there are oil and gas investments where you can get 75 to 100% write off on your AGI, your W-2 income. So, understanding, and we have a breadth in our personal portfolio. So understanding the stack I was talking about earlier, where it might be like 60% in a hard asset that brings you peace, comfort for the long term. And then
Yes.
maybe a layer in there of oil and gas for the tax benefit, against your W-2 income. However, it's a little more risky. However, it knocks down your W-2 income tax. So really understanding the breadth of what's out there to play with in the categories. And that's what I love helping people with. It's super fun to put together that puzzle, right?
That's amazing, Sarah. I love that. You have this kind of brand that I love, and that's creating confident investors. And and that kind of resonates with me as well. Where I see families, I think my families is what I like helping the most. But obviously there's a professional mom and or dad or something like that, and then they're successful, but then also maybe they're not confident in like, oh, I'm not smart enough to invest my 401k or put some money down in a private real estate investment. Where did that confident investor moniker come from and grow from? And how do you make people become confident investors today?
Yeah, I appreciate that. So I started doing online education and I did like a webinar here, a webinar there, and I was doing tons of webinars. And then, you can see in webinars what people are saying in the chat. And so there was so much content that people were like, wow, I didn't know that. Thank you. Thank you. And so from all those webinars, I took that content and I put it into a 3-day series. And again, if you go to sugocapital.com, you can access it because there's a recording of it. I've done it so many times. And so it's really condensed and fine tuned into the basics. So it's somewhere on my website. Sorry, I don't know exactly where, but it's the 3-day series. And so why do I want people to feel confident? Because I felt confident once I learned the basics. Like my anxiety around money, my anxiety around my future went way down once I learned like peaceful energy around money. Whew, doesn't
That's
that
huge.
sound nice?
That sounds super nice. Yes.
Super nice. And so, growing up, my mom did not have peaceful energy around money. There is this anxiety around money, anxiety around, are we going to have enough for the future? And so now she invests with me. She's like, I'm very confident I'm going to be just fine. And so that is, I'm getting chills all over my body, but it makes everything so worth it when people tell me that, like that they feel really peaceful about their financial future because they know how to invest in what's right for them. And so it's very rewarding to me to go from a place of anxiety around money to helping others get to a peaceful place around money and their financial future. And then also the question of how do we do that? Well, if you're looking at investments and you're trying to learn about them at the same time, there's something called lizard brain. I don't know if you've heard about this. I'm probably going to get it wrong, but it means that when you're trying to make a decision, especially around money, the logic side of your brain does not work as effectively as it normally does. And so
Right.
that's usually when people get anxious and they don't make a decision and they feel unconfident. And so what we do with the Confident Investor series is we educate. We have this 3-day series. And we're not offering anything. We're not offering coaching. We're not offering investments. We're just educating so that people can absorb the information they need. And it's the basics. It's like probably what you take your coaching students through is, okay, what do you want? When do you want it? Cash flow, wealth building, legacy building. Okay, next step, next step, next step, next step. Here's the terms you need to know. Here's how to do due diligence on properties. Here's how to do due diligence on teams like myself.
Right.
Find out if I'm legit or not, and other people out in the internet land are legit or not. And then finally, financial modeling. You know how to understand when you're going to get what amount of money at what time. And so we do that when people are not trying to make a decision about money. Then you can absorb it. Then you can figure out your questions, watch it again, ask me, whatever it is. Now you're like, I get it. So then when you go and look at an investment, it's not foreign. You're like, I understand. I can do my due diligence. I have a checklist from Sarah. and you can make a decision, right, not right for you. But you've already done the learning. So that's that's the process I take people through, and I think it works really well. Is people come to the table with knowledge, and they can make the decision themselves, basically.
I could just feel the sense of confidence that you can inspire, Sarah, and even the peace. Like, oh my God, I'm getting relaxed here. Listen to you just talk so calmly and confidently about this, and like how that could work with a newer investor. Like, yeah, I'm really really resonating with that. So really good. And it's all on your website, like you said. Is that 3-day conference or that 3-day seminar? Is that free or is just a
Oh,
link
it's
or
all
was that?
free. All of our content is free. Yep.
Amazing. And I'll drop that in the this is recorded live as we know, but I'll put that in the podcast notes and drop it in the live link and on LinkedIn and Facebook as well. So people will have that and go there for an excellent resource that you've provided for our audience.
Yes, it's under the events tab. I just found it.
Nice.
sugocapital.com/events.
Like
Even
it's
though
been a while. Jump in there and check that out where that is.
yeah.
What advice would you give Sarah for beginning? I think we've probably already touched it, but again, just to kind of make nice precise bullet points
Mhm.
for a beginning professional. Let's say they hear this, they see it on LinkedIn or Facebook or somewhere online, and like, oh, I want to get in. And that we talked about a lot of things, interesting stories and processes and how to do things.
Yeah.
What are some things that they should do today or tomorrow if they were to see or listen to this? If you just had to like get that nice little crisp list.
Yeah. I say the first two things. The first one is decide what you want and when you want it. So a lot of times people are thinking about, oh, I want to quit my job in 10 years, so I need to focus on cash flow.
Yeah.
No, you don't. Not today. Today you need to focus on wealth building. And then in 10 years, you're going to switch your strategy to cash flow. But really getting clear on when you need the thing and what's appropriate for you right now is what I think is the first step that people often get wrong. So if you want cash flow in the future, focus on wealth building now. If you're about to quit your job next year, then find those passive cash flowing investments. But be really clear with yourself. And then step two is, I call it, who do you need to tell? And so that's either making a plan with your spouse, your family, your business partner if you own a company, and being really clear about your goals and your timeline so you can make a plan with the people who are in your ecosystem. And then being also really clear who you need to add to your ecosystem. Is it someone like Johnny who's going to help you come up with that plan and execute it? Is it someone like me who has the investments that are going to get you to your goal? Is it a CPA who's going to help you with that complicated tax strategy so you don't have to? So I think it's deciding what you want and getting the right people on your team in your ecosystem aligned with the plan. And you won't get anywhere if you have a fuzzy plan. If you have a clear plan and you tell the right people, that's how you're going to get there.
Amazing. How do you vet those professionals? And you obviously you know your spouse, but they see you or I out there doing this or that, like you said, the due diligence on the people in internet land. What have you found to be successful for people to get that confidence? I mean, we think we're so intellectual, but also the croc brain does kick in, and it's like, who knows someone that knows the space there? What have you found to be, what are some shortcuts or some heuristics that you use, Sarah, or you've seen other people use?
Yeah, so definitely asking people who are in your same situation. So a lot of times people ask me, "Oh, who's your CPA, Sarah?" And I'm like, "My CPA is not the right CPA for you.
Yes,
There's
yes,
24
yes.
apartment complexes, all these random, you know, offshore account things, whatever I've got going on. That's not everyone else. So go find someone who's in your position, be in a community of people who are in your position or a little bit more along the path, and ask them who's in their ecosystem and who they recommend. And you'll get some pretty strong recommendations. You'll get some pretty strong, once you're in those communities and you start asking, you might even have 5 people who recommend the same CPA and say they're good,
Yeah.
for W-2 earners who want to mitigate tax and, have the connections to the oil and gas type investments. Like if that's like, be in that community, ask, get those
Yes.
recommendations. I think that's the best thing for the professionals. And then when you're looking for who to invest with, definitely ask. Sometimes it's harder to tell because those might be a longer time until you see the results. So like someone who invested with me last year might not know, they haven't exited anything, so they
For
don't
sure.
know, what are Sarah's results. But you can review track records. And if someone doesn't have a track record on hand that is everything, the good, bad, and the ugly, I wouldn't go with that person. There's a website called veravest.com. And so it has sponsors on there like myself who are offering things out to people. And it has a stamp that's called Veravest Verified. I forget what it's called. But it basically says, hey, we've done a full background check on Sarah, everyone in her company. And I actually 2 days ago I just renewed it and I got the full,
Nice.
this 80-page background check on me. They go through all my commercial loans, back to when I was 20, when when I got a parking ticket. Like it's all in there. They don't show it to the investors, but they basically say Sarah and her folks in her company are clean. At least
Yes, yes.
they don't check everyone, but the principals in the company. So that's a great resource. You can also do your own background checks, but there's some that are already done for you.
Those are great starts, and again,
Mhm.
when you're stepping into the space for the first time, you don't even know how, kind of where to start, who to ask, and kind of even a way to navigate that. It gives someone perhaps some framework, like, oh, that makes sense. I could do that. I could ask that
Mhm.
question, and just give them a starting point. The
Mhm.
whole point of this is just to get set yourself a course and take a step in that direction. We're not talking to like running a marathon or finishing this the next 10 days. We're like, hey, just take a step in that direction, start thinking about this, get the
Mhm.
confidence, like you said, about the confident investor, and thinking
Mhm.
about your family and what that financial future might and should look like. So
Yeah.
that's very exciting. Final chapter here as we wrap up the show here, Sarah. What trends or shifts do you see on the horizon in the real estate space market, or that the audience should be aware of? That you obviously there's lots of talk about shifting interest rates and some things like that. Is there anything that's kind of that you've had some deep insights on as you being that
Yes.
you live in the space so
So
closely?
So a lot of people see the shift in interest rates. What they don't see or realize is the shift in loan to value. So it used to be we could get like an 80% loan to value. Now we're getting like 55% loan to value. What that means is we have to raise more equity. What that means is money is more expensive, not just for the debt, but in order to make the purchase in general. And so that creates a situation where cash flow is much lower for investors. And, most people out there, syndicators, they're not going to purchase something if it doesn't make 18 to 20% annualized for their investors. Um, but it's not going to be in the form of cash flow the way it used to be. So a lot of investors are still like, I don't want that one. I'm waiting for one that has high cash flow. They're going to be waiting years. It's I mean, they say, I'll wait for your next one. I'm like, the next one might have lower cash flow. I mean, hopefully not, but having cash flow as a priority in real estate today is very difficult to find. It is out there. There is a way to kind of give investors cash flow that's part of the money raised. It's not really cash flow from the property. But that's the biggest shift I see And then as far as, so that's the shift that we've been experiencing over the last 9 to 12 months, right?
Yeah.
It's been slowly skinnier and skinnier cash flow. The annualized returns are still strong though. And so the biggest trend that I've done with my personal portfolio and shared with my investors is keep keep real estate investments for your wealth preservation, for your growth, and then find something else for your cash flow. So maybe you find oil and gas for cash flow, or maybe you have an Airbnb for cash flow, or maybe you have something that's totally you've never even thought of. There's so many cool things out there that are really, really alternative, but they
Yes.
can provide cash flow. They're not wealth preservation. They're not going to grow in appreciation or value, but they're strictly cash flow. So it used to be that real estate could do both for you. And now I'm saying, hey, you're going to have 2 investments for these 2 different purposes now. It'll
Yeah.
shift back. There's always cycles. It'll shift back. So,
Totally. And I think that just the benefit of being in this space, we call it real estate private equity, but it could just be private equity, and then these are the kind of things that sponsors like yourself are into and are chasing down and are keeping abreast of. How can you provide that value to your investors? And you see, like for example, you have the foresight and the knowledge to see that multifamily, for example, the returns of the cash on cash is shrinking. So then you're automatically going out there ahead of everybody saying, hey, what else can I provide so I can still keep my investors happy
yeah.
and keep this business sustained. And that's what you
Mhm.
that's what you do. So that's really, really amazing.
Yep,
Well,
exactly.
I think that's probably a good place to wrap it up, Sarah. So thank you so much for being with us.
Mhm.
And I love doing this doing a live episode of the Investing Stuff You Should Know podcast. The final thing, and I'll leave the good word with you, is how should people? I think you've mentioned a couple times that what's the best way for people to get in contact with you? LinkedIn, Facebook, Instagram, website. What do you like?
Oh, LinkedIn is good. We have a lot of strong content on LinkedIn. However, if you go to sugocapital.com, there's on the front page, there's a ROI calculator. And if you download that, then you're on my email list. And we provide education and, all of our events that are coming up are marketed to that email list. So if you want to be on the email list, sugocapital.com, download that ROI calculator that's on the front page, and you'll be added to our list, and you'll get tons of education, and it's all free because I want everyone to make the best decision for themselves and their family.
I love it. Until next time, everyone here at the Investing Stuff You Should Know podcast, we'll see you. And if you leave us a like and spread the word, we can bring more great guests like Sarah back on here. So until next time, thank you.
Thanks for having me here, Johnny. Thank you so much.
Yeah.